I'm Jon Marino, Senior Editor with The Deal, covering private equity, joined by Brian Korn of Pepper Hamilton. He's their securities attorney. And we've picked a pretty great day for it. We're right out of the gate after a few big IPOs. Bain Capital's Burlington was probably one of the biggest ones to come out in a while, a very successful IPO for them. Right now in the IPO market, we're seeing some trends pick up, and obviously it's a huge year for issuances. What are you seeing specifically?
Well, it's a very interesting IPO year. The market is extremely active right now. I expect this trend to continue through the end of the year and even into 2014 for the foreseeable future. There are a couple of factors that are contributing to this. One, we've had very stable markets all in all, given everything that's going on with respect to Washington and with respect to the foreign issues. You're really seeing a market that has really leveled off, and the volatility index being below 20 has historically been a great factor for IPOs. Second, you're seeing broad participation across numerous sectors. You mentioned retail, consumer retail. Real estate is participating with the Empire State Building IPO, for example, yesterday. You're seeing a very hot market in the healthcare sector with an extremely hot biotech oncology group, right. And as well as technologies, not to be forgotten, with also an extremely hot subgroup of cloud computing. All of these factors are contributing to a market that is wide open. Another factor that's really coming into play that you don't see and you hadn't seen in several years is that non-US issuers are choosing the US market as their market of choice, even if they don't have a real nexus to the US. For example, in Alibaba's case, right. They announced they're choosing to list in New York as opposed to Hong Kong for corporate governance reasons. And you contrast this to what we saw with Sarbanes-Oxley, where the non-US companies were looking to flee the country. Now it looks like the environment is welcoming them back.
Right, and obviously Alibaba will be a really big win for U.S. markets, provided that we do get it here. And then there's the Jobs Act also, which is kind of helping streamline the pipeline into public markets. Can you tell us a little bit about what you're seeing specifically from PE firms that are bringing companies public?
Well, I think it's been really great for PE firms to use the Jobs Act, specifically the provisions of the Jobs Act known as the IPO On-Ramp. Right. The IPO On-Ramp allows emerging growth companies, which are companies that have less than $1 billion of total revenue, to take advantage of certain onboarding features that are available under the Jobs Act. For example, companies can now confidentially file their S-1 with the SEC and respond to comments under cover of confidentiality, and then have to publicly file only 21 days before they go out. This means that a PE firm can test the viability of the transaction and not take reputational risk or business risk on the deal until they actually know the deal is viable. The downside for the market is that we have a lot less visibility on the pipeline because a lot of these transactions are going on under cover of night now. Secondly, reduce financial information. Companies now need only show 2 years of financial statements instead of 3, and only 2 years of selected financial information instead of 5. And then most impactful, I think, is the ability to delay your compliance with Sarbanes-Oxley auditor attestation, which was a big cost out of Sarbanes-Oxley. That is now put off for these emerging growth companies.
All right, and then there's the other factor of the Jobs Act being now that the general solicitation ban has really been altered substantially. Ultimately, this was at first billed as a bill that was going to be helpful for venture capital firms and for startups, but ultimately it's also helping private equity out. Can you talk a little bit about how general solicitation applies specifically for PE?
Absolutely. So one of the, I think, the big unintended consequences of the Jobs Act was the relaxation on the ban on general solicitation. Generally in the United States, all securities transactions either have to be registered with the SEC, such as public offerings and ongoing stock transactions, or qualify under a private placement exemption. The majority of these private placements underwent a process known as Regulation D, where you were not allowed to engage in a public solicitation or general solicitation or advertising. And I think what Congress didn't understand really or intend is that the ban on general solicitation doesn't just help startup firms and VC firms, but also PE firms and anybody doing capital raising or fundraising. So this involves not only corporates that are raising money, but investment funds, private equity funds, hedge funds, anybody out there who is doing a capital raise into their own portfolio that isn't doing it through a registered SEC process.
Right. Well, thank you very much for joining us today. I appreciate your perspective.
Thank you very much.
I'm Jon Marino for The Deal.